Hello everyone, Woody here, back in the hot seat for the next Fat Tail Daily video. I'm joined by my good friend and colleague Brian Chu. Brian, how you doing, buddy?
I'm doing all right, Woody. How about yourself?
All right, all right. Now, how much of the inauguration have you been watching?
I actually slept through it because it was 4 a.m. in the morning, and I was up pretty late last night just checking what's going on with gold stocks and all that. It's not that I'm not interested in the inauguration, but I think I had to look after my health first,
Yeah,
and people are sending me footages and talking to me about different things, so I'm in the action.
good, good. Yeah, I figured you might be interested at least. But anyway, your piece today, obviously, it's about the gold sector. And there's one number actually that caught my attention. It's in your first line of the piece, 27%. Now that's how much gold has risen in US dollar terms in the last year, and it's his best performance since 2010. But here's what's really quite fascinating. Unlike previous gold bull markets, the junior miners still haven't yet caught up or caught fire. So I wanted to discuss and unpack this, why this unusual disconnect might spell opportunity for investors in 2025. So let's start with something that jumped out from me at me from your analysis. You've highlighted, Brian, that gold explorers are significantly lagging both producers and the physical metal in this cycle. Why is this unusual?
Well, it's unusual because in the past bull markets, you would expect that if you look at gold stocks themselves, the bull market technically started in around late 2022. So it's been 2.5 years, almost 2.5 years since this bull market's been running. And as I said, with bull markets, you usually start off with the big companies taking the lead, and then the small companies, the small caps, not only catching up, but it should overwhelm the big the larger companies. In this case, with small caps, a lot of these explorers and early stage developers are still very much behind.
Mm-hmm.
One thing that's likely to be holding them back is the length of the bear market with the smaller end of the gold stocks. What I mean by how long it's been a bear market, the gold stocks in the last bull market, probably that bull market ended in around January, early 2021, and then started kind of sagging, and then they got hit very hard in 2022 as the price of gold went down by quite a bit, and then oil also went up significantly. You had about 3.5 years where these companies, which most of them aren't actually turning in any profits or making a cent from production, they had to keep raising capital. So it's almost like a really severe bushfire that went through the landscape. And in a very burnt landscape, it takes quite a long time before the green shoots come out. And then, furthermore, you see the forest actually flourishing. So that's why there is a significant disconnect. If people want good returns from gold, they could have bought the bullion, they could have bought the larger companies, so the mid-tier producers. So that's why the capital hasn't really flowed in to the smaller end of the market, and that's why there's a significant disconnect,
So
with a
that's
few
the
exceptions, of course.
that's the cause of it, and that's the reason for it. So why might this present an opportunity in 2025?
Well, I believe that in any bull market, especially for resources companies, these types of disconnect will close, and they can close violently for the following reason. You have many of these explorers and early stage developers, they do have a good quality deposits, as in I'm not just talking about the ones that have a piece of land and they're doing remote surveying, they're flying over and using heat maps to detect where the anomalies are. Anomalies as in patches of land where there may be um, a bit more magnetic responses coming out, magnetic signals coming out of them. I'm talking about companies that own deposits. They just haven't been developed, or they bought it from an old for a company that's depleted most of their resources and they're still drilling holes in the ground. So recently, some of these companies are showing activity in terms of they have raised capital to they have released mine plans, they have raised capital, and they're in the process of building a mine. Or there have been larger companies that have decided to buy um, these mines or the company itself. So there is actually activity happening.
Yeah.
And investors are slowly warming to it. We haven't seen a stampede into this particular space.
You discuss how companies like Southern Cross Gold, Black Cat Syndicate have found success by essentially thinking differently about old mining sites. Can you elaborate on this trend of reimagining historical deposits and what it might mean for the junior mining sector?
Okay, so for some background for Southern Cross Gold, Spartan Resources, and Black Cat Syndicate, Southern Cross Gold bought the Sunday Creek mine site, and it was, I think, back in the 1800s. It was actually a mine, and it was underground shaft mining. The company went like once the mine stopped operating in the, I think, the 19th century, so in the 1880s or so, that piece of land was largely abandoned. And Southern Cross Gold bought the land. They had a look. They actually went through the records in a library to look at what where these people dug, and then they decided, well, there's plenty of areas where the the deposit body may actually have additional places where if you dig further, you will probably find the rest of the mineral body, which is exactly what they have located in the many holes that they drilled. Some of these holes stretch for hundreds, if not 2,000 meters, if I remember. Actually, no, 500 meters long, and they actually contained rich seams of gold and antimony. So they haven't confirmed the resource yet, but from the many holes that they drilled and where the patterns are, we are looking at potentially a very big resource. Now, with Spartan Resources, they used to be called Gascon Resources, and some of our viewers may have invested in that company back in the day. They were a mine, the Dalgaranga mine, and the company went into administration because the mine was not turning a profit. The open pits, the surface ore, the grades weren't high enough, and at the same time, they had borrowed quite a bit to build the mine. That's why it wasn't profitable. But when they, during the time when they put the mine, the processing plant on care and maintenance, as in just suspended production, they decided to drill underneath the processing plant and found significant underground ore, and the Never Never deposit, as well as the Pepper deposit, those are now one of the highest grades of undeveloped um, underground ore, which the company is going to plan to build to actually restart the mine with that high grade ore to support the open pit ore, and that's going to be very profitable.
Mm.
With Black Cat Syndicate, they purchased the Paulson's mine from Northern Star and the Coyote mine, which was also from Northern Star, but once ran by Tanami Mining. And the company explored the ore body further, found additional ore, and is now in the process of producing their first gold in this quarter. I think in the December quarter already. So they're going to report how much gold they've dug out. So reimagining these mines, just because a mine's old and abandoned doesn't mean that there's nothing there.
But it feels like there's a trend taking place
Yes.
in that obviously technology has gotten better, but also the higher value price of gold, especially in Aussie dollar terms, it's meant that these to revisit previously inaccessible gold resources from abandoned mines is a lot more economical now, isn't it?
Yes, that's exactly right. The way mining works is you you find an ore body or you discover that there is minerals there. You start digging. You dig the cheaper, the easiest to access metals first. Then, depending on what happens with the price of the commodity, which is cyclical, you might stop produce. You might actually stop operating there because you've got the low hanging fruits. Whatever is remaining, that's great, but not right now. It costs too much to process, pay the people, and keep the lights on.
Yeah,
Let's abandon the mine for now, sell it to another company, and then that company, because they paid a low price for it and they identify potential, they're going to sink capital in to look for more ore body and hopefully determine what is a profitable way to get that out of the ground in the next upcycle of the commodity.
yeah.
So it's quite as much as one would say we have very limited resources in the world, we actually don't have as limited resources as we think. It's just the cycle of the commodity makes it that these ore bodies would take several stages to extract whatever is beneath the ground. And
We've actually
in
got
that process,
a pretty cool presentation coming out later this week on that very idea.
yes,
But Brian, you point out that gold has had its best year since 2010, but the market reaction seems different this time around. How do you see the Trump administration's policies affecting gold and gold stocks differently, or are they the same than in any previous cycles?
I believe that with the Trump administration, because they are quite pro mining, they are pro manufacturing, they also no longer follow the Kyoto Protocol and the whole green agenda the way that the Biden administration and many of the more progressive, left leaning governments are. They actually want to um, bring mining back into action because you can't manufacture, you can't consume without natural resources.
Yeah,
And we also want if they also want efficient energy, and it is with cheap and efficient energy that you can multiply production. What we experienced the last, especially the last 15, 20 years, is this whole chicken little reaction to climate, false claims of climate change made through bad science, circulatory citation of academic papers that suit an agenda, and never publishing or disparaging publications that um, claim anything otherwise. So oil prices went up, that restricted production. Consumption continued to increase, which created inflation. When you have cheap energy, that creates a virtuous cycle of more production, lower prices, consumption no longer becomes as restricted. Of course, within sustainable means, I don't disparage completely the whole sustainability idea. It's just that there should be common sense rather than an ideologically driven approach and not allowing open dialogue on what is really happening. The science is never settled, and the only science that's ever settled is when there's big money involved. And we hope that there's a common sense approach with the Trump administration and the increasing um, emergence of more conservative or right-leaning governments in the Western world coming up that support more nationalist um, nationalist ideology, bringing back manufacturing back in the country, not going around and promoting various agendas to other countries and policing other people. Back to common sense. Hopefully, that would lead to a new era of the global economy, the way people do trade, and the way countries deal with each other geopolitically and from a societal point of view.
But I think from very, very minimum, or at least the cost of mining with oil prices, with the new policies of starting up the drilling again, that should mean energy becomes a bit more abundant, therefore cheaper, therefore mining operations should be more profitable. And maybe we could just end on a final question, bringing that back to gold miners and how you show a couple of charts in your piece today which show the divergence of producers and juniors in the mining sector, especially gold stocks. With the lower cost of doing business potentially coming, what do you think will typically trigger the catch-up phase for the junior miners, and what signs should investors be watching for in 2025 to anticipate that move potentially?
That's a very good question, because if you look at the chart, the difference between gold, the larger gold producers, and the gold explorers and early stage developers, we did see the producers start turning up significantly from March last year, and that was off the back of the price of gold rising above and staying over 3,000 Australian dollars an ounce. And at the same time, the operating margins of these larger companies improve significantly. So how do the operating margins, what affects the operating margins? The difference between the price of gold and oil, because mining uses a lot of fuel, especially diesel, and the price of diesel is quite linked to the price of crude oil.
Yeah.
Now, as the price of oil stabilized below $80 a barrel, that caused the gold to oil ratio to rise above 30. And we've actually lived through an extended period of the gold to oil ratio being above 35 since around September. And it's around this level. It's it's a sweet spot once the gold to oil ratio is above 25. Above 30, most of these producers should actually be delivering very generous margins. When these gold producers rise to a certain level, they will taper off because of just the relative price and to value ratio. Now, when that happens, people are going to turn towards the smaller end of the market because they're chasing returns.
Yeah.
Just a hierarchy of how things work, and we are expecting that should the March quarter also show pretty generous margins, and these producers are trading at maybe 10-20% above the current prices, that capital will shift towards the small end of town. That's my expectation, simply because a lot of the investors and speculators will jump on board from the good news that's been permeating in the gold mining space.
Cool. All right, Brian, we'll leave it there. Thanks for that. If you'd like to check out Brian's full piece, the link is below. It's absolutely free. It'll take to the Factor Daily website where you can read the full analysis. Check it out. Let us know what you think. Thanks very much, Brian. See you next week.
Thanks, Woody, and everyone. God bless.